Hey everybody, this is Greg Gossett from Gossett Trading and Mentoring, and today is Saturday, May 31st. I hope you're doing well. I hope you're having a nice weekend. I hope you had a good trading week last week, and I appreciate you coming and spending time for my weekend review. I hope you are going to find it helpful. I hope you'll kind of get some ideas of how I look at trading, how I look at potential entries, how I set my stops, how I take partial profits, all the things we're going to do in the podcast today. So the actual format is, first of all, we're going to run the U.S. legal disclaimer. Secondly, we're going to come back. We're going to take a look at all the trades that I made last week, all the positions that I have from last week, both the ones I entered and exited. We're going to talk about when I entered the trade, why I entered the trade, what the signals were, what the confluence of signals were, how I position size correctly, how I place my emergency stop, how I place my end of bar stop, how I take partial profits, how I go into trailing stop mode, and then ultimately how I exit the position fully if it gets to serious overhead resistance level. So hope that gives you a good idea of how I look at trading in my mind and how I set things up. The key with any trade, everyone, is be patient, wait for a confluence of setups, position size correctly, enter the trade, and after that, you have no control over it. All you have is the control over what you are going to do based upon what the trade does, and you have to know exactly what you're going to do. If it does this, I'm going to do that. If it does that, I'm going to do this. So, ultimately, big picture, I'm very patient. I wait for the good setups. I get in, but I don't have any control. So all I have the control over is getting out quickly when I'm wrong and staying in and having a process to keep me in when I'm right. We want to be very impatient with losers, and we want to be very patient with winners. But day to day, you can't make decisions day to day. I guess you could. I wouldn't recommend it. But you actually have to have a plan. Get yourself a trade plan, everyone, and more importantly, follow it. That's the key to being a long-term successful trader. All right. So when I entered the trade, why I entered the trade, and how I am going to manage the trades going forward. After that, we're going to do a little bit on trader psychology. Always the most important part, and the most important skill, of trading is the ability, like I just talked about, of creating a plan and following it, and that has everything to do with what's between your ears, with your brain and your psychology, right? So it's always helpful for me to teach it, and I hope it is helpful for you and improves your trading as well. And if anything today that I speak of, if you find it helpful or valuable, I would really appreciate it if you could hit the thumbs up button. Helps to build the channel, helps to keep the channel around, and just lets YouTube know that there's some valuable content here. So I would really appreciate that. And if you haven't subscribed, subscribe as well. That'd be great as well. After that, I have gone down through my master watch list. I do it every Friday night. I go down through my master watch list, one market at a time, one symbol at a time, and I look for a potential trade for next week. And I'm looking for confluences, combinations of support levels, maybe an order block, maybe a 200-day moving average, maybe a 30 RSI, maybe a double bottom with a bullish divergence, right? I want to find as many things that come together that show me that either, we're running, if I want to go long, that we're running out of sellers, that there's support down there, just everything I can do to put the odds in my favor. And I've identified on the daily here 11 of them, both long. Some are long positions, potential long, some are potential short positions. And the key as a retail trader, the greatest advantage that we have over the large traders, the large financial institutions, is we can be patient and wait for those markets to get to those levels. Sometimes they won't get to those levels. That's fine. We just go into another market that does. So it's a big advantage that you have. Use it. I would suggest, like me, go through your watch list on the weekends, look at a chart and go, golly, if Apple got down there, it would have this, that, and the other, and that would be a pretty good place to start on a trade, right? But you have to be patient and wait. So the ones that I'm going to show you, they're not quite there. If they were already there, I probably would have already taken the trade, but they're within striking distance, and I'll just have to watch them next week to see if they actually get there. So I hope that's going to be helpful for you as far as getting an idea of where they are, where ideally that they would go, right? And if they get there, then I will definitely consider taking the trade. So, okay, I'm going to run the U.S. legal disclaimer quickly, get that out of the way, and then we'll get started. So hang tight, please.
This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Please carefully read and/or listen to the U.S. government required disclaimer before watching this video or live stream broadcast. The video link and disclaimer text are located in the description section of this video or live broadcast, here and here. Thank you so much.
Okay, let's get started, everybody, on the current open positions that I have. So this is Google, G-O-O-G-L, and I did get long Google here on the 7th of May at, what is that, 151.47. It's been a really nice trade on a big down bar. So you might ask yourself, why would you get long on such a bearish bar? Well, this particular strategy is called a bullish order block, and I use order blocks a lot, both bullish, bearish. I teach them to my students, and ideally, I like to have a combination of an order block, maybe a deep dip buy. But this particular one was just completely an order block, and let's first of all talk about what an order block is. An order block, the setup for an order block is, first of all, you need to find on the chart somewhere a swing low. Well, this is a swing low. Has a higher low to the left, has a higher low to the right. Swing low. Followed by a swing high. Well, this is a swing high. Then you need another swing low that is lower than the first swing low. So low, or swing low, swing high, lower swing low. And then in the future, if you can make it above that first swing high, as we did here, actually, now you have changed market structure from a bearish market structure to a bullish market structure. And so when you change from a bearish market structure to a bullish market structure, as soon as you do that, I look to the left and I look for the lowest bar close prior to the bullish market structure change. And that happens here. So I have the high and the low of this bar, and this is the high and the low of the order block going forward. Now, just because we change market structure to the upside doesn't mean I come in and buy, but now I know it's a bullish market structure, so I can feel more confident buying dips. Remember the old saying, right? Buy dips in an uptrend, sell rallies in a downtrend, or sell rips, right? Buy dips in an uptrend, sell rips in a downtrend. Well, the reason, based upon the formation here of the structure, is that when we have a swing low, a swing high, a swing low, we change market structure to the upside. Now I feel confident buying dips in the order block. So I have the high and the low with the bar. I run it out into the future. Now at any point when we get back into the green box, into the bullish order block, I can feel comfortable buying. And you can see, as soon as it got back to the green box, it took off. I didn't take this trade, but I was waiting. I wasn't expecting, but then we had this big down bar, and this is where I bought. And the reason I bought it was because the price came into the order block and then rejected it and closed the pop above the top of the order block, just barely, but it did. And so alternatively, had it come down, gone below the low of the order block, and then closed back in the order block, that would have also been a legitimate entry. So I got long here at 151.47 because it rejected the top of the order block. Now, As soon as that happens, let me get my calculator over here because I'm just going to try to run you through exactly how I do this. So as soon as I have an entry signal, rejection of the top of the order block in this case, first thing you have to decide is how many shares am I going to buy? And, this is probably your most important decision of the trade, to be honest with you. And the way that I do it is I take two things into account. One, how much is in my trading account? Let's just say it's $100,000. Okay, that's the first thing. The second is what is the value of the 2 ATR, or the 2 times the average true range? Well, right at the moment, it's 1074. This changes every single day. So first of all, with the account value, I take 1% of the account value. You can take 2, you can take 3 if you want to be more aggressive. You can take 0.5% if you want to be more conservative, but I use 1%. So 1% of $100,000 is $1,000. I take the $1,000, I divide it by the value of the 2 ATR, divided by 1074. That tells me to buy 93 shares. And this exact number is based upon how much money I have in my account, what my maximum allowed loss is. My maximum allowed loss is 1%, $1,000, right? That's why I have the $1,000 here. And then what is average true range? Well, average true range is how much should this move any particular day based upon the last 20 days. Well, I double that number because if it can move 1 ATR easily during the day, but it's expected to do that. I want to place my emergency stop 2 times that amount. So if I'm wrong, I'm really wrong. Does that make sense? Okay, so we have the bullish order block. We rejected the high of the order block. I know I want to enter this position. $1,000, which is 1% of my account, divided by the value of the 2 ATR, tells me to buy 93 shares. Okay, enter the trade, boom. Now, the first thing I do after that is I take my entry price minus the 2 ATR, and I put this red line down here. This is my emergency stop. This is the worst case scenario. So if I have 93 shares and they move 1074 to the downside, how much have I lost? Well, we did the math. I lost $1,000. That's my maximum allowed loss. That's 1% of my account. It's not fun, but it's recoverable. But the good news is this emergency stop, in my experience, happens about 5% of the time. So only 5% of the time am I actually going to lose this $1,000. The other 95% of the time, if I have a losing trade, it is going to be based upon my end of bar stop. And my end of bar stop is just a close below the low of the order block. Remember, I had the high and the low of the order block. So if the next day it had closed here below the green box, I would have gotten out of the trade for a loss. Now, would it have been $1,000? No, because at the emergency stop, it's $1,000. And this is actually kind of, for me, this is kind of a long ways away from my end of day stop, but it's fine because order blocks are for me, they work very well. But make sure you understand that. Entry price minus the 2 ATR is the emergency stop. And the next day, if it just came racing down there, I'm immediately out. But going forward, if we close just below the low of the order block, I get out as well. And instead of losing $1,000, maybe I lose $400 or $500 or $300, or if it's closer, $100. But that's the key. Trying to have your entries as close to your end of day stop as possible. I always have my emergency stop, always. But the end of bar stop is important. You want to have it as close as you can. This one's a little wide, but it's fine. All right. So rejection at the top of the order block, position size, place the emergency stop 2 ATRs below my end of bar stop. If it closes, the keyword is closes below the low of the order block, I am out. The very next thing that I do is I take my entry price, then I look at the value of the 1.5 ATR. Right now, the 1.5 ATR is $8.05. I take my entry price plus the 8.5 above, and now this is my trailing stop level. If when I take the trade, if it moves my way and gets to trailing stop level, then I go into trailing stop mode. And all that means is now, if I get there, it doesn't mean I do anything. It just means now I'm in that trailing stop mode, which means that in the future, if I have a close below a previous bar's low, I am going to exit half my position. So why do I do that? Well, when that happens, it has the effect of tightening all your stops and moving it all up because you've sold half of your remaining shares. Okay, so very important. At the moment, everything we've talked about, the position sizing, the emergency stop, the end of bar stop, going into trailing stop mode, these are all defensive maneuvers. Or in other words, if the stock moves against me, I need to take action defensively. But I also like to play offense in my trading, just like in sports. You need to play offense and defense. Trading, to me, is a sport that I need to play offense in. So how do I play offense? Well, I sell a portion of my position into any strength on any one particular day. And I'll tell you how I do this. So I'm still in this trade. I'll show you how I do this. I take the closing price of the day. Right now it's 171.74. Now I look for the value of the 0.45 ATR. The value of the 0.45 ATR is $2.42 today. It changes every day, but today it's $2.42. So I take the closing price plus $2.42. My first profit target for Monday is 174.16. And if Monday it gets there and gets to 174.16, I am going to sell 10% of the remaining shares that I have. If I have 50 shares remaining, I'm going to sell 5 at that first profit target. Now, I always set 3 profit targets. So 174.16 is my first profit target. So I take 174.16, I add the 242 to it again, plus 242. Now I have a second profit target that I'm going to put in my system as a limit order at 176.58. And how much would I sell there? The same as the first, 5, 10% of however many shares I go into the day. So that's my second profit target, 176.58. I'm going to do it one more time. 176.58 plus 242. My third profit target is 179 even. So I have 3 profit targets that I'll put in the system as limit orders for Monday only. If I had 50 shares, 5, 5, and 5. And if the market goes down on Monday, well, I don't hit any of them, do I? And then if it goes down on Monday, then I'm going to redo it for Tuesday based upon the closing price. But selling while you have a profit, to me, is very important. There's many advantages to it. You're reducing your position size. You're taking the count heat off. It's easier to follow your process. And if you have a big move back down, well, now you're going to mitigate any loss because you have sold and gotten rid of the shares, right? A part of them on the way up. So it just, to me, it makes so much sense. You know, there's nothing worse than having a big nice gain and then giving it all back, right? By taking these partial profits, that's never going to happen to you. And by taking these partial profits every day, you're also, just regardless, you're going to sell some near the top, 100%. All right. Okay. So I know I'm spending a lot of time here on Google. I'm not going to spend this much time on the rest, but I'm just trying to set things up. So real quick, let's start again. Rejection of the bullish order block long 151.47. Position size correctly based upon my account value dividing by the value of the 2 ATR. Place my emergency stop 2 ATRs below my entry. My end of bar stop is a close below the order block. I place my trailing stop level 1.5 ATRs above. And now I know exactly what I'm going to do in this trade regardless of what happens. The next day, gaps up, goes up. I hit 1 profit target. Great. Next day down. no profit targets. Next day, up, another profit target, maybe two, I can't remember. Next day, up again, I can't remember if I hit a profit target or not, but I did get to trailing stop level. Now I'm in trailing stop mode, which means that if I have a close below a previous bar's low, I'm going to get out of half. Next day, big ups, multiple profit targets for sure. Remember, I'm in trailing stop mode. Next day, down on the day, no profit targets. Next day, up, profit targets. Next day, open down but recover. Here on the 20th, we have I hit one profit target earlier in the day when it was up, but then it reversed. Now I have my first close below the previous bar's low. After reaching trailing stop level, what do? I sell half of the remaining shares that I have for a gain of 7.56%. So pretty nice, right? Next day, shoots up, multiple profit targets, locking in those profit targets, reducing my position size. The market can't take it away from me. The next day, up again, more profit targets. Now, at this point, everybody, I get to the 65 RSI. And when I get to the 65 RSI, now I have another rule that kicks in, which means that if I at least get to the 65 RSI level, now if I have a close below the 5 EMA, that is my rule to exit the entire position. Alternatively, if we go up and we get to the 70 RSI level and reject that, then I exit half of my position, half of the remaining shares. And then in the future, if I have a close below a previous bar's low, I get out of everything. All right, so I know this sounds like a lot of rules. There are a lot of rules. I've been trading for 30 years. These rules are here for a reason, to optimize how much money I make and to make trading easier. And it's important that you get yourself rules. You know, I teach private one-on-one lessons. I teach a 15-hour course. I teach people from all over the world. And I've done this for many, many years. And I've turned out some really great traders. So, you know, I use 7 different trading strategies. And so if you're interested in becoming my student, just send me an email. My email is in the link of the description. I'd love to speak with you. I'd love to have you as a student. And you're going to learn a lot and learn a skill. So if you're interested, let's start the conversation. So, but up here, we get to 65 RSI. So like I said, now a close below this 5 EMA, I'm out of the trade. Well, here it held. Next day up, hit more profit targets. Next day up, another profit target. Then the last couple days down, do you see how 2 days in a row we have gone below the 5 EMA during the day, but then closed above? And then on Friday, we were way down. I thought for sure I was going to exit this trade, but it just barely recovered at the end of the day, which kept me in the trade. But Monday, if we close below the 5, I am out. So the remaining shares that I have on Google here are up 11.87%. So you can see that order block really nailed it, didn't it? And this has been a really great and beautiful trade on Google. So remain shares up 11.87%. All right, let's go to Amazon. Okay, Amazon, completely different type of trade. This is what's called a bearish island reversal. And you can see the red block I have here of these 3 bars. What makes this, why did I highlight these in red? Well, this is called a island reversal. Why? Because we gapped up. You can see the huge gap up, boom. Sideways motion, didn't do anything, and then we gapped down. This is bearish. This is a bearish scenario. When you see a gap up, sideways, and gap down, in over 70% of the time, in my experience, you're going to see the prices lower, not higher. So on this particular trade, this is a kind of a different approach that I use to manage these. It's very simple. I positioned when I got short here $205.90. Okay, so same thing, 1% of my capital divided by the value of the 2 ATR, place my emergency stop 2 ATRs above. But in this particular case, I only do 2 things. I place the emergency stop 2 ATRs above, and then I place my profit target 4 ATRs below. So if I lose, I'm going to lose $1,000. If I hit my profit target, I'm going to make $2,000 because my profit target is twice as much as my stop loss. So 2 ATR stop to the upside, 4 ATR profit target to the downside because I'm short. And so I just put the order in the system. Get me out if it goes up here. Get me out if it goes down here. That's it. Pretty simple. And, abandoned babies and island reversals are the only strategy that I use this approach on. By the way, if you'd like to learn more about abandoned babies and island reversals, go to my YouTube channel. I've got a video there that explains abandoned babies and island reversals. So this particular trade at the moment, when I started off here, we went down very nicely. It started off nice, then it's rallied back up. But this particular trade not doing much yet, but up 0.46% on this short. And I do want to point out, everybody, that one of my students, Vivek from Canada, I'll just show you here, highlight, because this has been a great trade for him. You see the red box here. This is one bar. This is an abandoned baby. An abandoned baby is the same thing as an island reversal, but it's just one bar. You can see we gapped up, boom, and then immediately gapped down. So there was all sorts of excitement, enthusiasm about gapping up, and then it was quickly reversed to the downside. So this makes an abandoned baby. Vivek, when it came up to the bottom of the abandoned baby and rejected it, that was his short. And so he put a 2 ATR stop up here and a 4 ATR profit target down here. And look, he just nailed it. Way to go, Vivek. Proud of you, bud. So I don't know exactly his numbers, but this is roughly up 5%. Correct me if I'm wrong, Vivek, but this looks like it's up about 5% on this short. So really nice trade. This is just a good example, not an island reversal, but abandoned baby because it started with one bar. But way to go, Vivek. Okay, so we've got Google, we got Amazon. Let's go to UNG. UNG is a order block trade. And again, I'll take you through why is this an order block? Because we have a swing low, we have a swing high, we have a swing low, lower swing low. We change market structure direction. Therefore, the high and the low of this bar becomes the order block. As we move forward, we reject the bottom of the order block. That's where I got long. 1566. I position size correctly. I place my emergency stop 2 ATRs below. My end of bar stop is a close below the low of the order block. It looks like 1405. I place my 1.5 ATR trailing stop level above, and next day explodes off of the order block, hit multiple profit targets, also got into trailing stop mode. Next day sideways. Next day first close below a previous bar's low after reaching trailing stop level. I locked in half of the shares for a gain of 6.01%. Then the next day we were up a little, not enough for a profit target. Next day up, did hit a profit target, thankfully. And then ever since that, we have come down. No profit targets, no nothing. But look exactly where the price found a bottom. Right here, basically where I bought it. It's actually technically up just a little bit, up about 0.45%. But it's interesting that it bounced right at the order block, then failed, came down, and this is exactly where we have support again. So the remaining shares are up 0.45%, but this is a good example, everyone, of why taking the partial profits when I had them and using the trailing stop level is so important. Yeah, I'm up 0.45%. Just call it almost even, but I'm not even because I took the partial profits when the market gave them to me. I'm still up nice on this trade because of the partial profits and the rules for the trailing stop level. All right, so going forward, if it moves up, I will continue to take partial profits, obviously. If it comes down into the value zone or into the bullish order block, fine. The only action I'm going to take is 1, if we come down and hit my emergency stop, or 2, if we close below the low of the order block, 1504. Okay, so that's UNG. DIA is a short trade that I took here on the 28th of May. Why? Well, Here you have a box, but it's not green, it is red. Why is this red? This is red because we have changed market structure from bullish to bearish. So this is the opposite. Look, we have a swing high, we have a swing low, and we have a swing high. Then we go below the swing low, which changes market structure from bullish to bearish. If market structures change to bearish, then I want to short rallies. Make sense? And that's exactly what I did here on the 28th of May when several things happened. We rejected the order block above, and we also rejected the 200-day moving average, which is the black line. So I position size, I got short for 21.67. I placed my emergency stop 2 ATRs above because I'm short. I placed my trailing stop level 1.5 ATRs below. Now, in this particular case, this is probably my favorite trade setup when you have an order block and you have a major moving average inside of it. So normally with an order block, my end of bar stop would be a high of this order block. It looks like 428.65, but this one I like even better because the 200-day moving average, the black line, is my end of bar stop. So on Monday, if we close above the 200, I'm simply out of the trade. You see what a good risk to reward that gives me? It gives me a better risk to reward than having going to the top of the order block. So that's it. If it goes down, I'm going to take partial profits. If I get to trailing stop mode, I'll go into trailing stop mode. If it continues down more, I'm going to take partial profits. If it moves up on Monday and closes above the 200, I'm simply out for a fairly small loss, right? That's the best I can do, and I would recommend that you do the same. Set up these structures in your trading so that if you're wrong, you can be wrong small. If you're right, you have the potential for a big trade, right? Whether you learn it from me, like I said, I would love to be your teacher. I'd love to be your coach. I'll teach you everything I know. But if you don't learn it from me, learn it from someone else for sure. Okay. So this particular trade, I am down slightly on the trade, down 0.23%. And then Exxon. Exxon is a trade that I got into on yesterday, on Friday. You can see the green box down here. Well, that means it's an order block. And again, let's look at why it's an order block. For a bullish order block, you need a swing low, followed by a swing high, followed by a lower swing low, and then you need the price to take out that swing high to change the market structure from bearish to bullish. As soon as this happens, I look for my lowest bar close. After market structure happens, I look for my lowest bar close. Here's the high and the low. Here's the bar, the high and the low. And you can see, this is a very good example, really. We rejected the bottom of the order block. We went below it during the day and then we closed back above it. I got long 102.31. Placed my trailing stop level 1.5 ATRs above. My emergency stop, of course, is 2 ATRs below. Monday, if it closes below the order block, if it closes below the green box, even by a penny, I'm simply out of the trade. So you see what a good risk to reward I have. If it moves up, I'm going to take partial profits. If I gets to trailing stop mode, I'm going to go into trailing stop mode. But the key is position sizing correctly and having that end of bar stop close to you. Well, this is pretty close. I'm at 102.31. The low of the order block is at 102.13. Pretty close. So basically Monday, if it's down, I'm out. But if it moves up and it has room to move, do you see what a good risk to reward ratio that is? So basically even on the trade. So as I just got in it, but I remember when I got in, I was like, this is going to be good for the podcast because this is really going to show what a really good risk to reward ratio is. I'm right there, essentially. If it closes below, I'm just out. But if it has a swing back up, then it's potential for a big trade. And that's all you can do. Okay, so that is Exxon. So those are all the dailies. Google, remaining shares up 11.87%. Amazon, the short, up 0.46%. UNG, remaining shares up 0.45%. DIA, remaining shares on the short down 0.23%, and Exxon just exactly even. All right. So what do you see there? You see some like on Google, of course, you see a big gain, you see some small losses, you see some small gains. That's fine. Having big gains obviously is okay. Small gains, fine. Break even trades, fine. Small losses, fine. You just want to keep it away from big losses. That's the key. Now, so those are the dailies. Let's talk about the weeklies as well. I also trade weekly bars. Weekly bars close on Fridays and create a new bar for the next week. So this is a trade I've been in a long time, everyone. My gosh, this is TLT on the weekly. Why did I buy TLT? I bought it at 87.20. Well, I bought it because it rejected the weekly order block. So I position size, place my emergency stop 2 ATRs below. I place my 1.5 ATR trailing stop level above. Next week, went up, no profit targets. Next week, went up, no profit targets. Next week, went up. I was able to take some profit targets off it at a profitable level. Next week, nothing really happened. Next week, up a little. Next week, up big, where I hit multiple profit targets. So I'm taking more and more shares off at profitable levels, and I also got to trailing stop mode. So for the next 3 weeks, it basically moved sideways, down a little. Then we had the big week up here where I took more profit targets, thankfully, because look what happened the next week. Kaboom, all the way down. And I was in trailing stop mode, so the first close below a previous bar's low after reaching trailing stop level, I had to get out of half the position for a loss of 0.59%. Now I only have half the shares. The next week didn't do much. Next week up, took some more profit targets, thankfully. Next week up, more profit targets. Now we have 1 month in a row to the downside. We were up this week where I did hit some profit targets as well. So this trade, the remaining shares down 1.18%. But again, this is a good example of when the market was going my way and taking partial profits on these big up bars. Pretty good, right? Really glad that I did it. So yeah, this one, I've been in this one for a while, and this does pay a dividend as well. So at least I got a little dividend as well, but this one is down 1.18%. Okay, last but not least is Nike. Nike is strictly a deep dip buy entry, and deep dip buys have to do with the 200-day moving average, the 250-day moving average, the 300-day moving average, and or a rejection of the 30 RSI. I was teaching this last night to my student Andre in Indonesia. How's it going, Andre? And I think we had a good lesson last night. He told me he learned a lot, so look forward to our next lesson next week. But this is exactly what I was teaching Andre last night, was the deep dip by the under 30, over 30. So these are weekly bars on Nike. I did get long at 55.80 here on the 18th of April. Why? Well, first of all, during the week, we went under the 30 RSI and then closed above. Okay, that's the main signal. The reinforcing signal was that you see the gray line here, kind of the thicker gray line. This is the negative third ATR channel. 92% of prices when they get to the negative third ATR channel tend to stop going down, go sideways, at least in the short term, or go up. And on this particular bar, this is exactly what happened. So the confluence of signals on this bar where we went under 30 during the week, closed above 30 RSI at the close. And we also went under the negative third ATR channel, closed above. So I got long 55.80. I position size. I placed my emergency stop 2 ATRs below as always. My end of bar stop is, in this particular case, because the entry signal was an under 30, over 30, going forward, if it closed under the 30 RSI, I'm simply out. That's all there is to it, right? So as long as the closing price of Nike It closes above the 30 RSI, keeps me in the trade. So the next week after entry, it went up. I hit a profit target. Then we had 2 weeks sideways. Nothing really happened. Then this week here, I hit multiple profit targets, which is nice on this big up move. And I also got to trailing stop mode. And what does that mean? That means if I have a close below a previous bar's low, after reaching trailing stop, I get out of half the position. And that happened 2 weeks ago. We closed below the previous bar's low after reaching trailing stop level, locking in a gain. I took half of my remaining shares off for a gain of 7.2%. This week was up slightly, and I was able to hit a profit target near the high as well. So the remaining shares that I have on Nike up 7.86%. So nice little trade with a deep dip buy. And by the way, if you'd like to learn more about deep dip buys, of course, I teach them in my one-on-one course, but I also have a really good video available at udemy.com where I teach you the entire deep dip buy strategy. The video is 9.5 hours. It's a really good video. I've sold so many around the world. I've got such good feedback, so many emails. Greg, this is the best course. And it's super affordable. I think it's between $30 and $50 for the entire course on Udemy. They changed the price. I don't have anything to do with that. So I can't quote you an exact price, but roughly it's between $30 and $50. And if you'd like to learn the deep dip buy, one strategy, really, if that's all you learned, you would be fine and you would do great. So do yourself a favor, get that course, learn that course, and I know you're really going to like it. All right. So, okay, that's it on the weekly. So the 2 weeklies, TLT down 1.18%, the remaining shares, and Nike, the remaining shares up 7.86%. So that's it. Those are the dailies and the weeklies with the trades. So before we get on to taking a look at potential next week's trades, let's do a little bit about trader psychology, and because it is quite important, and then we'll get on to next next week's potential trades. So let's take a look here. Here we are. Okay, this is from Jesse Livermore, very famous trader. Some consider him one of the best traders ever. But Reminiscence of a Stock Operator, that book, this is essentially about Jesse Livermore. But let's see what Jesse has to say here. Losing money is the least of my troubles. A loss never troubles me after I take it. I forget it overnight. But being wrong, not taking the loss, that is what does damage to the pocketbook and to the soul. One more time. Losing money is the least of my troubles. A loss never troubles me after I take it. I forget it overnight. But being wrong, not taking the loss, that is what does the damage to the pocketbook and to the soul. Look, we are going to have losses all the time. That is the expense of our business as traders. Of course, we're going to have losses. And ideally, like Jesse says, taking that loss should really not bother you. It kind of stings at the moment, right? It's not fun, but really you do forget about it as long as it's not too big of a loss. And if you position size correctly and you have that emergency stop, well, we've talked about that already. But the point is, if you don't take the loss and you, for whatever reason in your mind, say, it's low enough, I don't think it's going to go lower, and you don't take, if your trading plan tells you to get out here and you don't take it, and then the next day it goes down, you're like, dang, I've been a lot happier taking it up there. I should have. And then it goes down, and then it goes down, and then it goes down. What are you going to do? Now you're in that horrible, vicious cycle of where the stock that you have is so low, and you'll get to the point where you think, well, yeah, this is a long-term trade now. Don't do it, everyone. It affects you. It affects, like Jesse Livermore says, it affects your pocketbook. It affects your soul. If I could give you the best advice in trading is when you have a loss, get out of the loss. Even if it closes 1 penny under your stop, get out. You can always get back in. And a lot of times they will come back for you, which is even worse because then it reinforces your bad behavior. If I could give you one piece of advice, get out when your trading plan tells you to get out. It's not fun. You're going to take the loss, but you're going to conserve capital. You can get on to the next trade, will hopefully be a better trade. But if you get into that black hole of you didn't get out and now it's down, and now it's more down, I'm sure all of you understand what I'm talking about, right? We've all been there. So losing money is the least of my troubles. A loss never troubles me after I take it. I forget it overnight. But being wrong, not taking the loss, that's what does damage to the pocketbook and the soul. Let's not damage our pocketbook and let's not damage our soul. And let's just follow our rules, because ultimately that is how you're going to make the most money. Follow your rules. All right. So hope that's helpful. Okay. Let's get on to the potential trades for next week. See what we got cooking over here. Okay, so before we do this, I want to mention, I have 11 different potential signals here. It is possible that all 11 of these could trigger on the same day. Does that mean I would take all 11? It does not. I only take one trade per day per time frame. So if all 11 of these triggered all on the same day, I would have to narrow it down to what's the best one. Well, I give each trade a score. Just to make it easy, if it has one entry signal, let's say I give it 1 point. If it has 2 entry signals, I give it 2. If there's another one that has 3 entry signals, I give it 3. Which one do you think I'm going to buy at the end of the day? I'm going to buy the one that has the highest score, right? And, what do I factor into that? I factor in the lay of the land, big picture, what's going on. Do we have bullish divergences, bearish divergences? I factor that in. I factor in how many other signals there are, how many entry signals there are, or confirming signals. I look at the higher time frame. If everything's equal on the daily, I look to the higher time frame. That may give me some clarity and insight and go, okay, I'm taking this on the daily. Oh, look at this. On the weekly, it's at the 200-week moving average. It's confirming signal on a higher time frame. So, and then I also look at the relative strength of the market. The market's down really big, but this one's actually up. Well, okay, that gets a point. That gets bonus points for that. So, try to get to the point where you can actually differentiate between different trades and go, this is a better one because it has more signals, or it has this and it has that. And again, this is what I teach all my students. I teach them how to come up with this quality score of looking at these different things so they can pick the best trade of the day. So like I said before, I would love to have you as a student. I will teach you everything I know in my over 30 years trading experience, and you will have a skill that you can use the rest of your life. And I've had so many students from the past just tell me, Greg, I'm so glad I took your course. I learned so much. And like I said, I'd love to teach you everything that I know too. So just send me an email. We can get the conversation started. So, okay, let's get to AGQ. Well, AGQ, you can see I have a green box here, which means this is a order block, right? So let's figure out why it's an order block. Well, here we have a swing low. Here we have a swing high. Here we have a lower swing low. This move up here took out this swing high, changing this from a bullish order block into, changing this into a bearish structure into a bullish structure. And now when it changes, I know this is the order block, the high and the low of this bar going forward. So if we get back into this green order block, that is a buyable area. But this is one of my absolute favorite type of setups, everyone. Look at the the orange line. The orange line here is the 300-day moving average. This is a deep dip buy signal. Just buying off the 300 is not a bad idea. Look what happened here. Right at the 300, bam. Doesn't always happen, but this case it did. But the point is that we have a deep dip buy signal, 300-day moving average, that is now living inside of the bullish order block as well, right? So you have two super key levels happening at the same time. you have the support of the order block, and you have a major moving average that lives inside of it. Now the question is, does it come down here? I don't know. If it does, ideally, look, there's 3 different ways I could approach this. If it rejects the high of the order block, I could get long there. If it comes into the order block and rejects the 300, I could get long there and then use the 300 as my end of bar stop. Or maybe it blasts through those and rejects the bottom of the order block and closes back in. So 3 different approaches: rejection of the high of the order block, rejection of the 300 in the order block, or rejection of the low of the order block. Ideally for me, rejection of the 300 in the order block, because 1, it's in the order block, and 2, it gives me a very good risk to reward ratio, but who knows? And it may not even get there. It may just take off from here or never get there. But this is a really good example of one of my probably my favorite trade: major deep dip buy moving average inside of a bullish order block. So I'll be watching this one closely. Alibaba. All right. Okay, well, kind of similar, actually, to AGQ, but further away. Alibaba, you can see green order block here. You can see at the top here, bearish island reversal, gap up, sideways, gap down. So, and inside this bullish order block, here's the 200-day moving average. Again, my favorite order block with a deep dip by moving average inside of it. Now, going forward, kind of the same with AGQ. If we reject the high of the order block, that could be an entry. If we reject the 200-day moving average in the order block, potential entry. If we reject the 250 in the order block, potential entry. If we reject the bottom of the order block, potential entry. Conversely, if we never get down here and we go back up and we reject the bottom of this bearish island reversal, I could get short. So, there's a lot of stocks where you're going to have buyable areas to the bottom and you're going to have shortable areas to the top. But ideally, a rejection of the 200 in the order block would be a nice place for me to think about getting long, or the 250. But the top and the bottom of the order block are also potentials, or if we rally and reject the high of the bearish island reversal, potentially get short. Salesforce. Right. Again, 2 different options on Salesforce and where it goes. So let's first talk about the bullish order block here. Why bullish order block? Because over here we have a swing low, followed by a swing high, followed by a lower swing low, followed by market structure change, which then defines the order block down here. Additionally, we have a bearish order block above. Why? Swing high, swing low, swing high, change market structure to the downside. So there's a lot of resistance here, and there's a lot of support here. Now that I'm thinking about it, this probably, for me, next week, I'll probably do some iron condor options positions against this, where I'll do credit spreads above and credit spreads below, because clearly there's resistance above here and support below here. But outside of options, and by the way, in my one-on-one courses, if you are interested in options, I trade options every single day of my life, and I can show you how to apply those to these strategies. So yeah, going down, if we come down and reject the high of that order block, potential long. If we go up and reject the low of the bottom of that bearish order block, I could get short here. But right now it is just stuck in the middle, so potentially getting short with the rejection of the bearish order block above, or potentially getting long with rejection of the bullish order block below. FedEx, okay, nice little order block here. Why? Swing low, swing high, swing low, market structure change, bullish order block. The reason I like this order block is because it's a narrow order block, giving me a good risk to reward. So essentially, if we come down, reject the high of the order block, I could get long there, or if we reject the low of the order block, I could get long there. Gold, GDX, which is gold miners. All right. You see the red above, that means that is a bearish order block above. We have the green below, that is a bullish order block, and it's my favorite. It has the 200-day moving average in the middle of it. Right now, we are closer to rejecting the low of this bearish order block. And if it does, I could potentially get short here. I drew the red line in the middle. Rejection of that red line, I could get short. Why? Because if we go over to the left, we have the big down bar. So usually when you have a big down bar and you get back to halfway, you're going to have some resistance there, inherent resistance. So to the short side, rejection of the bottom, potentially short there, rejection of the red line in the middle, short there, rejection of the high of the bearish order block. It's also an option to the short side. And then to the downside, we have this nice bullish order block below here, rejection of the high, ideally rejection of the 200 in the middle, or rejection of the low. Home Depot, order block just formed. Why? Swing high, swing low, swing high, market structure change. Defining this as the order block. Now this is a wide order block, so I'm not going to mess with any short of the low of the order block. But ideally what I'm looking for is if we do rally back up to the 200 and reject the 200 above us that's inside the bearish order block, that's what I would be looking for a short. Intel. You know, I was just talking about Intel in one of my lessons last week. But we are in this bullish order block. And if you've been watching this podcast for a while, you will remember, or maybe you'll remember, that I have had so many trades on Intel in this same order block. All the way back to here. Swing low, swing high, swing low, market structure change. Move the order block into space. I got long here with the rejection of the bottom of the order block. Nice move up, clearly. I got long here with a rejection of the order block. Nice move up. I got long here, rejection of the bottom of the order block. Nice move up. Didn't take this one, didn't take this one. But this is the order block that keeps on giving, at least for the moment. And look, now we are smack dab in that order block area again. It doesn't mean that this time it's going to do exactly what it's done and go straight up from here. Not saying that whatsoever, but all I'm saying is we are in this viable area. So my options to get long here would be if we close back above the order block, the high of the order block, that's one. But I don't know, I kind of have a sneaking suspicion that the next potential trade on Intel would be if it goes down lower, rejects the bottom of that order block, and then closes back in the order block, which I would prefer because one, it's lower, and two, it would give me a very good risk to reward ratio. But yeah, this green order block has been very good to me in the past, and you know, actually anyone that has bought it inside this green order block at some point has had a nice trade. So again, I'm looking for a rejection of the low of the order block. Let's go to McDonald's, MCD, just basic bullish order block here. Swing low, swing high, swing low, market structure change. Kind of a nice narrow order block. You can see a couple days ago we got close to it, never quite got there. So rejection of the high or the low of that order block would be a potential entry for me on McDonald's. Rio Tinto, RIO. Okay, we have a swing low, we have a swing high, we have a swing low, market structure change. This is the lowest bar close before market structure change. Look, we are right in there. It's exactly, it came down, it's exactly where it caught some bids. So potentially to get long Rio, we are in the middle of the order block now. So I guess I could have taken it on Friday with rejection of low of the order block. But going forward, ideally I'd like to see it come down, thoroughly reject that bottom and close back in. That would give me a better risk to reward ratio. Or alternatively, if we reject the high of the order block and close above it, that could be a potential long. So I'm looking to potentially get long here. Rio with the rejection of the high of the order block or rejection of the low of the order block. United Airlines, again, order block, swing low, swing high, lower swing low, market structure change. But it would have to come back down to this order block. The high is 75.10, the low is 72.90. So somewhere rejection of the high or the low of this order block. And then last but not least is oil. Oil's been kind of out of favor, but there's a nice juicy order block down here at reasonable levels, I might say. So we have a swing low, followed by a swing high, followed by a swing low, followed by a move up that changes market structure. This defines this green area as the order block. The high is 63.02, the low is 61.75. We're not there yet. We may never get there. But if we do and reject the high of the order block, that would be a potential long entry, or reject the low of the order block, that would be a potential long entry as well. All right, let's get to the weeklies and then we'll call it a day. All right, weekly bars now. Close on Friday. Apple, I've been talking about this for weeks. And I haven't got long Apple because it hasn't got there, right? If it doesn't get to where I identify the level, I don't take it. Well, here's a beautiful order block on Apple on the weeklies. Remember, these work on any time frames. I use them every day during the day. But this order block goes all the way back to 4/19/24. Over a year ago, I'm keying off this level from over a year ago. The high and the low of the order block moving forward. Remember now, back in April when we had the big collapse in the market, look where the price got to before it bounced. The order block, right? These are no joke, everyone. They don't work all the time, but they work a whole lot more than they don't. So, ideally, if I could have my ideal world, look at the 250-week inside of the bullish order block. That would be ideal. I don't know if it's going to get there or not. Probably not. But more likely, it could potentially have a rejection of the 200-week moving average. That would just be a deep dip buy. It's going to get there. Don't know, but if it does, that would give me a good structure of a trade for a good risk to reward. So potentials going forward, rejection of the 200-day, potential rejection of the high of the order block, potential rejection of the 250 inside the bullish order block, most ideal, or a rejection of the bottom of the order block. So again, I don't know if it's going to get there. Very likely it won't, but if it does, these are the areas that I'd be looking for. AMD, Advanced Micro Devices. This one could get there. Look, we have a new order block. Swing low, swing high, lower swing low, market structure change, defining this as the high and low of the order block, 97.91 to 76.48. Now, rejection of the high of the order block. Okay, maybe I take it. Risk to reward's not so great, but potentially. I like the green line here in the middle of the order block. Why? Because this is halfway of this big up bar. If you have a big up bar and it comes back to halfway, you're going to have inherent support. And then as always, if we reject the bottom of the order block, that would be a potential too. But right here, rejection at 87.50 would be my favorite place to buy. But it's a long ways down, so I don't know if it's going to get there. But again, looking at the charts, looking at the ideal locations and saying, man, if that rejected 87.10 in that bullish order block, came down to halfway at that big up bar, look, if it gets there, I'll be taking the trade. I'll take that for sure, but maybe it won't, but we'll see. Russell 2000. Now, this one is very likely for next week. We have a bullish order block. It's very wide. Swing low, swing high, lower swing low, market structure change. So just a rejection of the high of the order block like it did on Friday. Fine, but that's too big of a risk for me. What I'm looking for ideally on IWM is for it to come back in the order block, reject the 200 week. That would give me a good risk to reward ratio. Or alternatively, if we come into the order block and we reject the 300, that would be pretty sweet. The Qs. Well, I guess I should make this red because this is a bearish order block. That's why I'm not really bullish at the moment on the market. Not because what I read, not because studying, but just because of the technicals. We have a swing low, we have a swing high, we have a higher swing high. We change market structure to the downside. Well, this creates a bearish order block. Look, The last 3 weeks, when we have got to the bottom of the bearish order block, that's all there was. That's all there was. Went a little higher this week, but it's all there was. This bearish order block right here is some pretty significant resistance. Now, I could have taken this trade on Friday. It didn't because I have another short, right? I shorted Amazon. I shorted the Dow. But ideally, what I'm looking for is a rejection of 532. Why 532? If we go to the left, we have the big down bar. Halfway of the big down bar is 532. That's inherent resistance there, and it's inside a bearish order block. So if we're able to get up to 532 and reject it, very likely I would get short the Qs there, and then my stop would just be closed higher of the order block. S&P 500, SPY is the same, everybody. Bearish order block above us. SPY has not been as strong as the Qs. We have not challenged the bottom of the order block. If it does challenge the bottom of the order block, maybe I take a short there, but ideally 606 is the area that I'm looking for a rejection, because if we go to the left, it's halfway of the big down bar that happened on 221. So, as far as the market in general is concerned, everyone, you can see there are major bearish order blocks above us. Now, some news came out, some good economic news or geopolitical news. Yeah, maybe we break out and we go to all-time highs. I'm not saying we can't do that. But at the moment, the market has not proven it wants to do that. And at the moment, the market has proven it has not been able to get above this order block. Eventually, if it can't get above this or get to it, it will go down. So that's why I'm a little bit more bearish now, and I have the bearish positions in Amazon and Dow. Tesla. Well, Tesla took off like a rocket ship. Again, order block. Swing low, swing high, lower swing low, market structure change. Defining this as the bullish order block. I could buy with the rejection of the high of the order block, but again, my ideal location, really my ideal location now, is this rejection of the 200-week moving average inside the bullish order block. That 200-week moving average also dovetails with this green line. What's this green line? It's halfway of the big up bar. What is that area? 253. Yeah, it's 90. Yeah, it's 90 points below us. Is it going to get there? Probably not. Probably not. But if it does, that would be the spot. And who knows? Maybe we wake up next week and it is there. Well, that's the place I would take it. No one's forcing me to take any trade. I need to look at these charts and go, where is the sweet spot? The sweet spot's there. So if it gets there, I better think pretty hard about taking that trade there, because I already decided that was the spot. Walmart. Okay, simple order block. What makes it an order block? Swing high, swing low, higher swing high, market structure change. Now we're coming back up into the tough spot above us. The highest up bar closed before the market structure change. If it rejects the bottom of the order block, I could get short there. If it rejects the high of the order block, I could get short there. Last but not least, thankfully, healthcare. I like healthcare. Why? Because nobody likes it. And the technicals are telling me so. This is a beautiful order block from in the past, moving forward into the future. I've talked about this for weeks. Could have taken the trade here on the 16th, but I didn't because the risk to reward wasn't so good. But I like, if we come back down, reject the high of the order block, check, that's potential entry. Or ideally, look at the deep dip by 300-day moving average inside the green order block. That, my friends, is what I'm looking for. So anyway, I hope that kind of gave you an idea of what I look forward to in the next week and how I try to identify these kind of sweet levels where all the confluences are happening. So like I said, if you liked today's podcast and found value, I would really appreciate if you could hit the thumbs up button or subscribe. If you're interested in doing private lessons with me, please let me know. I do a 15-hour course. I teach you all 7 of the different trading approaches that I use. I teach you all the rules. I take teaching very seriously. the success of my students is very important to me. We do a lot of teaching, a lot of simulations where I teach you, but then you need to prove to me that you know it. I don't ever want to let a student go unless I know that they know what they're doing. And like I said, I've turned out many all around the world, and I'd love you to be the next one. Keep in mind, I have the Deep Dip Buy stock trading strategy available at udemy.com. If you like video lessons, great course, really, and very, very affordable. So appreciate you being here. I always like to leave off with, please try to go out and do something nice for someone today. If we all did one nice random act of kindness every day, if we all did it, just by default would make the world a better place. If you could try to go out and you have it in your heart to try to do one nice thing for an animal each day, that's always a good thing. I was raised with many animals, and they appreciate act of kindness just like we do. But appreciate you being here. Enjoy the rest of your weekend, God willing. I will see you next week, but this coming week, please be careful. Get yourself a process. Follow your process. Follow your rules. Get out when you're supposed to. Protect your pocketbook. Protect your soul, like Jesse Livermore said. All right, everyone. Thanks so much for being here. Have a great rest of your weekend and a good week next week. Talk to you soon. Bye.
U.S. government required disclaimer. Stock, options, futures, and forex trading is not appropriate for everyone. While there is a potential for large rewards, there is also a substantial risk of loss associated with trading. The material in this video or live broadcast is not geared towards any particular individual or to any particular financial situation and is not intended to meet the particular investment objectives of any viewer. This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Any and all information contained in, implied, or referenced by this video or live broadcast is not to be construed as investment advice, and no representation is made that any individual or entity involved in production of this video or live broadcast is an investment or financial advisor or is registered or authorized to give any financial advice. We are publishers and educators only. Therefore, the various producers of this video or live broadcast will not accept liability for any loss or damage of any kind which may arise either directly or indirectly out of the use of any of this material, including any loss of profit. No representation is made that any account or investment will or is likely to achieve the profit or losses demonstrated. We recommend consultation with a licensed and qualified professional before making any investment decision. This video or live broadcast is not to be construed as an offer to buy or sell any security, financial instrument, or financial product of any kind. Notice is hereby given that any individual or entity involved in production of this video or live broadcast or their clients may have an interest in any security, financial instrument, or financial product mentioned or referenced. Any simulated or hypothetical performance result depicted does not represent actual trading and therefore may under or overcompensate for the impact of various market factors such as lack of liquidity. Thank you.